Over the past few days, the stock market has been really down. The Dow Jones has fallen by over 20%, followed by a short rebound. One of the main reasons it has collapsed is due to the coronavirus. The coronavirus is impacting many businesses. It is causing factories to shut down, which is preventing many other businesses from getting their products to sell. Also, when businesses don't have products to sell, B2B businesses do not have as many customers, which is really impacting our entire economy. This has caused the stock market to fall dramatically over the past few days. And the unpredictable market has created some opportunities and some really risky investments due to the uncertainty. Today, I'm going to show you 3 coronavirus-proof stocks that are going to be safe and that are really undervalued in the market today. So the first stock I'm talking about today is Google. Google is a company that makes money from advertising. Google is one of the most important places for businesses to advertise because it allows them to get a tons of traffic because almost everyone in the world uses Google. This is going to make Google take very small hits during the coronavirus period. And in most cases, if businesses cut their advertising entirely, they're going to fault because they're not going to have any more customers. Google is still going to have a lot of demand for their service in 2020 when the coronavirus is going rampant. And over the past years, we have seen that more people are clicking on Google ads, which means that they're being more effectively used to drive traffic for businesses. And also, we have seen the cost per click for Google ads decrease, which means it's going to be easier and cheaper for advertisers and businesses to market and sell their product. This is going to make Google a more dominant advertising platform in 2020. They also have a really brilliant and powerful platform, YouTube, which you're on right now. YouTube is really phenomenal for Google because it can't be competed against. I bet whenever you look for a video, you're going to go to YouTube first, because YouTube is like the source for all videos. Almost all major content creators are on YouTube and nowhere else, which gives Google an excellent advantage almost every other single competitor in the video making industry, which makes Google a very excellent investment. If you take a look at their financials, Google currently has a forward PE ratio of 19. They are also expected to grow by 15% per year over the next 5 years. A 15% growth rate is really cheap for a stock that has a forward PE of 19. This means that they are very undervalued because they have a really high growth rate and a relatively low forward PE. And also, when you look at their balance sheet, they currently have $119 billion in cash, but only $74 billion in liabilities. Google has so much cash that they can pay off all of their liabilities if they wanted to right now. They can pay off all of their debt, which is really good in these uncertain times where revenue and profits might be a little shaky. The next stock we're going to talk about today is Union Pacific Corporation, ticker symbol UNP. Union Pacific Corporation is a railroad that delivers a lot of goods and services for businesses. They deliver stuff like fertilizers, chemicals, raw materials, and like oil. All of the items they deliver are essential. They deliver stuff like food, plastics. Businesses and consumers cannot live without these products. This means that the demand for their products will not decrease a lot during these uncertain times. Most of their business is tied to transporting goods, and they're not transporting many people, which means that the coronavirus is going to have marginal impacts on their business model compared to other railroads who also transport people. Travel bans are only on people and not on goods. Goods are still being exchanged like normally as long as the businesses are able to produce them. Also, Union Pacific Corporation is mainly tied to the US economy, which is really good. I would rather be in the one strongest economy than in many mediocre economies. And also, since they are tied to the domestic economy, they are mainly involved in interstate commerce. And interstate commerce is actually really hard to restrict because it really is dangerous to the domestic economy, and it has really drastic effects in slowing down the economy. So it's really rare that the government's going to ban or put many restrictions on interstate commerce. And if we take a look at their financials, they have a forward PE just under 17, and they're expected to grow at about 11% per year over the next 5 years. This makes them a really good business financially and really undervalued. Also, many people assume that since it's like a really old business model, they assume that the profit margins are going to be slim, like 1 or 2%. However, Union Pacific has really good profit margins. They have a profit margin of 27%. Since they have a really high net profit margin of 27%, they're going to be able to eat in any costs and any extra expenses that come in. And if business does slow down, which it will a little bit for Union Pacific during this time, they're going to be able to eat up the cost and their business will be able to thrive. Also, when we take a look at their dividend, they have a dividend yield of 2.73%. This is a really solid dividend yield, which also makes it a good dividend stock. It also has a payout ratio of only 42%. Since the payout ratio is relatively low, the firm will be able to grow their dividend in the future, which makes this a really good dividend stock. And in fact, they have been growing their dividend at about 14% per year over the last 5 years. This makes Union Pacific a really good dividend stock and a really good value stock. And the third stock we're going to talk about today is Facebook. It is one of the most dominant social media platforms that owns Facebook and Instagram. It is really hard for new social media platforms to grow, because you need a lot of people on your social media platform to actually start growing. But the problem is, how do you get the first people on your platform without having anyone? It's kind of like the chicken and the egg problem. You need people to be on your social media platform in order to get more people to join your platform. But how do you get people without actually having anyone on your platform yet? This gives Facebook a really strong moat against competitors. In the past, their monthly active users has been growing consistently, and this is a really good sign that they will continue to grow in the future. In fact, by 2022, Facebook is expected to reach an additional 100 million users in India alone, which is a really good sign that they're going to continue to expand despite having over 1 billion people on their platforms. What's even more important is that their average revenue per person has been consistently increasing every quarter, with some spikes during the really hot months of November and December. This means that people are staying on the platform longer and that ads are generating more revenue for Facebook, which is going to be really important for their growth in the future. When we take a look at their financials, Facebook has a forward PE ratio of only 17, which is really low. And they are also expected to have a growth rate of 13% per year, which is actually really good. The company only has a forward PE ratio of 17, despite having a growth rate of 13%, which is really good. When we take a look at their balance sheet, Facebook currently has $62 billion in current assets. If you don't know, current assets are assets that can be liquidated into cash within a year. These include receivables, stocks, and cash itself. These are things that can be converted into cash really quickly when they need it. When we compare their $62 billion in current assets to their $32 billion in total liabilities, they have so much more cash and assets that can be converted into cash to pay off all of their debt. And this is really important in these uncertain times where revenues are going up and down. This is going to help Facebook pay off any debt that they need to, and it's also going to give them a really good cushion during these uncertain times. Thanks for watching the video. I hope it has really helped you. Make sure to drop a like, subscribe, and let me know down in the comments what stocks you're planning to buy when the market is down.